There's a lot of things that makes a good investment. Naturally, it all comes down to the investor themselves. There are many types of investments out there. If they're trying to add an asset to build wealth, there'll be different investment models for that. If they're trying to achieve cash flow, whether that's short-term cash flow, long-term cash flow, there's different products for that. But ultimately, let's be honest, let's not beat around the bush. The whole idea of investing is to get better returns on your money. So the most important thing I would say is your return on investment.
I had a client the other day. He reached out. He's a young individual. He's inherited some money, and he said to me, "Christian, you got loads of experience in the finance world. What is a good investment?" And I thought, what a great topic that we could add in our podcast.
Agreed.
So if someone asks you that question, I'll give my answer, but
yeah,
what would
no,
you
absolutely.
say?
We're here to add value. Look, let's be honest, there's a lot of things that makes a good investment. If you're talking about a property investment, then let's be honest, you've got to start about the property itself. But before we go into what I believe is a good investment, it naturally all comes down to the investor themselves. There are many types of investments out there. If they're trying to add an asset to build wealth, there'll be different investment models for that. If they're trying to achieve cash flow, whether that's short-term cash flow, long-term cash flow, there's different products for that. But ultimately, let's be honest, let's not beat around the bush. The whole idea of investing is to get better returns on your money. So the most important thing I would say is your return on investment. Now, again, working backwards from that, it all depends on what the individual is looking for. So I'll give you an example. If someone's looking for a low capital investment and they want a high cash flow, then it might be something like a rent-to-rent service accommodation property deal as such. That they're the ones that we've sold thousands of, as most people know. If someone is looking for, they actually want to own the asset themselves, then it would be something like a buy-to-let would be something that I would advise them to go down the route of. So you're not necessarily going to get the high cash flow, but you're going to own the asset at the end of the 25-year term, which is the wealth. I mean, that's the way that I would start. Ultimately, it's all about return on the investment.
Great. I mean, yeah, I agree entirely. The way I've always approached it, and this sort of harks back to the time when I was in Geneva in Switzerland dealing with not just the expat community, but also ultra high net worth individuals. When anybody came on board as a client of mine, the first thing I would do is say, what is your appetite to risk?
Yeah.
And I used to draw a line, there's 0 and there's 10, and I'd say, where do you want to be in that line? And, typically some people would put 3, some would put 7, and I would say, what are you trying to then achieve out of that investment? And therefore you can structure an investment accordingly. You have very, very low risk investment, like investing in bonds, which are government backed, which will earn very little, or you can put something in a savings account, that's going to earn very little, or you can go into emerging markets and very volatile, also currencies like Bitcoin that swing, in vast areas of up and down, and you can make a lot of money, you can lose a lot of money. So for me, the structures that I used to do were, I used to build portfolio investment where you would have an assurance wrapper. It's in a wrapper bond,
yep.
And out of that bond, we could invest into various different markets, and you would have probably 70% of the whole investment in low risk, and then 20% in medium risk and 10% high risk. And by doing that, you're getting a what's called a balanced portfolio. Your risk element is floated to a very small amount of your capital, and therefore by that you can afford to lose that because you're supported in the areas that are lower risk. And typically I would be returning for clients 16-70% per annum in that sort of structure. Now that's not for everybody, and we're a property investment group. So what is a good investment in property? Yes, owning the asset, the typical way of investing in property, but that's a long-term investment typically. So whether you bought a property, you let it out, that person that's letting the property off you for whatever period of time it is, you're probably running a mortgage of 20-25 years. You could ultimately let the property out for 25 years. That person paying the rent is paying your mortgage. You've paid off the mortgage over the 25-year period, yep. And you've got a huge asset, yep. That goes into your pension fund. So that's a typical, there's no issue with that. You're going to get the capital appreciation on the property, et cetera, et cetera. Outside of that, then you can get creative because, as you mentioned, there's the short-term element to getting money out of an investment, whether it's short, medium term, long term. And there's ways of utilising funds. What we do specifically at Unique Property Group, we have two main areas of investment opportunities for clients, which are all fixed term, guaranteed and secure. And that's one of the premises to look for. Look behind the scenes, look and delve deeper into the contracts and the structure of any investment that is being proposed to you, and look at where is the guarantee, how is that structured, how does it affect me if there is an issue with the company, etc. And so what we do, we structure a completely hands-off opportunity for clients where they're able to invest in us, piggyback off what we do with a number of our housing providers, where we have a structured fixed-term rent guaranteed scenario where we're receiving a rent roll, and in effect we can offer that rent roll out to a client. It's structured outside of the main business, so it's in an SPV, so it's completely secure. So even if anything happened to us, the guarantee's in place, which is why we're happy calling them guaranteed products. And those clients can earn a very healthy return in the region of 20% per annum over a fixed term period. So this is a short term investment, maybe 24 months, 36 months. But those are the contracts that are backed up in the background. There's the guarantee in place and the way we structure it. Outside of that, another great investment, which is something we offer, where you can own the asset. So you can own the asset, it's yours. You can do whatever you want with it. But what we do, we throw in a long-term housing provider, so you get a guaranteed rent position for a 25-year period. But then we get clever. And not many people are doing this in the market, but we get clever, and it's all based on yield-based assets. So the valuation of the asset is what yield it can achieve, rather than it's just bricks and mortar valuation, which a surveyor will give you. Because ultimately that asset, that property is going to be giving its revenue generating for the 25-year term, typically around 10% per annum. But then we get creative, and we've done this a number of times now. We might put a whole apartment block together. Clients might take 1, 2, 3, whatever units for a set price with the 10% yield. We'll then wrap it up within a 3-year period, and we will sell that whole asset then to a pension fund or a wealth management group or investment fund, hedge fund that we work with in the background. And we will give that client a 30% uplift in the value that they bought the property. So they've enjoyed that 10%, they then get another 30%, and then this is where it gets really interesting from an investment point of view, and this is probably one of the key areas if you're wanting to generate and build wealth, is compounding the level of your initial investment. If you compound it and compound it and compound it. So within that 3-year period, you've made a 30% uplift, you've made 10% per annum, you've got a great profit. What do? Well, you jump into the next block what we do, and then within a year, 2 years, you compound it up another 30%, and then another 30%, and all of a sudden, within a 5 to 10 year period, you've compounded your initial investment that you've placed multitude of times, and you're starting to build huge wealth.
Interesting. Yes, look, let's talk more about these deals you're talking about with the fixed term investments, and why now that's become one of our largest chorus products out there at the moment. Now, from an investor, when, let's be honest, regardless of what scheme it's running in, whether it's service accommodation, whether it's this, whether it's social housing, assisted living, ultimately they need to be aware, but ultimately, let's be honest, they just want to get their return on their investment. The fantastic thing that I love about these products, and so do our investors, is now we're not allowed to call them guaranteed, but because of the way that they're structured, and it's really refreshing to see to an investor where we can turn around and say, this is what we're doing over the next 3 years, here's why we're doing it, here's the benefits of others that use this, so it creates a win-win situation. They understand what happens in the operation, but more so from an investor, they understand that their money is not only safe, it's guaranteed to be paid to them on a monthly basis. That, if you look at the industry that's out there at the moment, it's unique, excuse the pun.
Well, it is. I mean, I've had so many investors say to me, so I put the money in, and you hold the whole capital. You just pay me the interest on a monthly basis, and you give me the capital at the end.
So again, we get a lot of questions like that. A lot of people need to understand. So let me just touch on that. The way that these operations work, as we know, the funds go into growing the operations. So it adds more properties to the government-backed agencies that they desperately need. Those funds go into raising those properties. That's why it's structured at different levels. But they're not investing in those properties. They're not the landlord. They're not responsible. What then does that helps the organisation grow their portfolios, which they're massively well behind on, and also as well because they're government backed, the rents are guaranteed, so they don't have to get involved in that. That's why we can offer the structure that we do, so the payments come every single month. From an investor, it's perfect. They know that their money is not only safe, but they know that it's guaranteed to come back. Now, a lot of investors say, well, what happens after the 3 years? A lot of people think the money just sits there. The money goes straight away. The minute that's invested and the allocation is taken, those funds then go to raising those properties up. It might go towards, let's say, for example, there's 50 clients that all take an allocation at once. That might go to a new block. That block might cost £500,000 to get operational. That's how it all works. The money is paid on a monthly basis with their interest across a fixed term of 36 months. What they can then do at that stage, they've got all their capital back and their interest, then they can either enjoy those payments or they can reinvest and keep going.
Yeah, and some clients, depending on the level, they look at utilising some of those funds that are coming out on a monthly basis to then buying in again and then buying in again and again, so that they, within a sort of 5-year period, they've compounded that level of interest.
And let's be honest, a lot of the investors that we've had, let's say in the last month alone, 90% of these investors get to their first month, see their first payment, they always reinvest again, because a lot of investors will turn around and say they've got X, Y, and Z, and it's irrelevant what an investor will have. As you know, some investors reach out and go, I've got £500,000, I've got £1 million, I've got £100,000. There's a structure to how much money we can take because it is linked to these allocations that we get from our government providers.
Yeah, we've turned away a number of. I mean, we've had people turn up, want to place 5 million, want to place 3 million.
We had someone yesterday,
and we just don't do that. So we have because it's allocation based. It's based on the rent roll profit line on each property that we do. Although it's over the overall properties that we have in the program, because. Otherwise, we would be structuring, the investment would overtake the properties we have, so we have to have an allocation.
Correct.
And it's so important that people understand that, because it is a well-structured investment strategy. But having said that, it's not just about the allocations. The allocations, of course, incredibly important. But the question is, we want to build a pool of investors that we can work with long term. So we're not interested in a quick buck. This is a long-term relationship that we want with these investors.
Certainly.
And if we just dealt with these large investment groups that have got 5, 10, 15 million to dump into
like
something.
Like a hedge fund.
Like a hedge fund, who are an absolute nightmare to deal with. Sorry, hedge fund guys, but you are.
No comment.
We want to be able to work with individuals, family syndicates, little smaller investment groups, and those investment groups might have £500,000, £1 million, but they can then get involved in other things that we're doing. So where we are going to be buying assets.
Sorry to interrupt, but just to add to that, hedge funds are fantastic. Some of the ones that we work with are amazing. For this product, it just doesn't work.
No, it's not the right product for them.
It's the only asset is something where it's where we sell all the blocks, apartments. We put it in a great big pretty row, so to speak. It's perfect for the wealth management groups out there. You may be listening. It's perfect for that. This product isn't. As much as they love the fact that Lewis Christian. So if we put in X, Y, and Z, it just doesn't work that way. Like exactly what you said, from the allocations that we get from our providers. And also another thing is a lot of people say, well, who else is involved in all this? We've seen other companies offer X, Y, and Z. I can't discuss or I've got no idea how other people operate, but this is all direct. We are direct to the government agencies. We are direct to the developers, and that's it. That's unique. And everywhere in between, there is no middlemen. There is no co-sources, as they call it in the industry. There's no other people. Most property deals, there's 3 or 4 people getting involved in it. That's what they call co-sourcing. All of this is direct, and it makes unique.
Exactly. I mean, just to clarify, I don't have a problem with hedge funds. But just on this particular investment, we've had a number of hedge funds reach out to us.
A large number.
Yeah, a large number. And it's not structured for them. It's not an investment that we can do £1 million.
It's not sustainable.
Yeah,
it's not a sustainable
it doesn't
investment for
work.
someone to go, here's £10 million. Don't get me wrong, as an entrepreneur and a business owner, turning down multiple millions on a regular basis, it's not something you'd likely do often.
No.
However, this is based on the values of the operations and the win-win situations they create. It's not designed for someone to come along and dump millions of pounds on it.
But if you are a hedge fund listening, please reach out and we will treat you very well. But from a hedge fund point of view, it's much more interesting where we're taking blocks and we're putting long leases in place and selling those assets as a yield-based investment, which works perfectly.
As an example of that, let's just briefly touch on the wealth group that we're working with at the moment is overseas. They've just purchased a block of flats off us for £12 million. It's 96 units, £12 million. It's fully tenanted, and it gives them a yield of just over 6%. And they will take that and they will hold that in their portfolio for many, many years. It creates a win-win situation.
Yep.
The investors that we put into that block originally, that they buy them off, I think the uplift was around 50%, where we guaranteed it to be 30%. And like Christian mentioned earlier, they then buy into another one of our products, which is similar, depending on where it is in the country. They enjoy the fixed returns, which is 9-10% yields. And if we then buy it back off them in 3 years' time, it goes again. It's not for everyone. But if you look at the traditional way, I call it vanilla way of buy-to-let, where you buy a property, you'd have to put 25% or 20%, depending on your credit, let's say 25% loan to value. So effectively, you'll take a 75% mortgage. Now, there's a lot of things that will impact that. The interest rates have gone up. Tenants aren't always going to pay you rent if you've got a bad tenant, etc., etc., etc. There's so many pitfalls with that. This is the modern way of owning an asset. And there's no other company offering those sort of products out there.
Yeah, own the asset with a hands-off experience.
It's perfect.
You can, backseat, growing your capital.
Let's talk about my first property deal.
Okay.
This was way back when, in 2000 and... end of 2016, start of 2017. Everyone that knows me knows that I'm passionate about property, have been for a very, very long time, always wanted to get involved in property, didn't know how. I was working as a regional manager in a large recruitment company. Then I got involved in the accommodation side. So I learnt the accommodation side. So I thought, I've got that. Now I need to know, how can I buy a property? I always just thought, like most people, you just got to save up and buy a property, get a mortgage. Then I come across a strategy called rent-to-rent service accommodation. Effectively, you can rent a property and rent it back out, put it on Airbnb, you can make that money. I saw some YouTube videos, I bought a book off someone, and I loved the idea. So my first property was a four-bedroom apartment in the Reading town centre. And at the time, the most popular apartments were 1 beds and 2 beds. But coming from my industry, we used to house large volumes of workers, and we would rent 5-bedroom HMOs, hotels, because you could fit more people in there. So I just presumed that it was good to go and get a large property. So everyone at the time was like, why on earth are you taking on this property? You would never make any money. So I took a bit of a risk, took a bit of a gamble. I bought it off a deal sourcer. I paid £4,000 for this 4-bedroom property in Reading. Me and my partner, Kelly, way back when, went and furnished the whole property. And did I make some mistakes? Absolutely. I spent far too much money on furniture. We spent £10,000 redecorating. It was unfurnished. We put zipper link beds in each of the 4 bedrooms, which if those of you don't know what a zipper link bed is, it's like a hotel bed. So if you went to the Premier Inn, there'd be a double bed. If you asked them to split it down, they basically just zip them together so you've got 2 singles. So in a 4-bedroom flat, I could fit 8 people. Then we put it on Airbnb, took some photos. It took us about a month to get there. And I think within an hour of it going live, we took a £4,000 booking for 6 weeks. In our first month, we made over £2,000 profit. In the second month, it was about £1,500. The third month went down a little bit. But you could clearly see that there was a business model there. Unfortunately, what we soon realised was that it wasn't guaranteed. There was a lot of work involved in the back end of dealing with guests, dealing with cleaners. And it wasn't as hands-off as what I was originally for. It was more like taking on a full-time job while I was running my other job. However, it was lucrative. We made certain mistakes. And that's what they class as rent-to-rent service accommodation. We quickly realised that there was a massive market for it, but I also realised at the same time it was a lot of personal work and energy into running that on a daily basis. So it's not hands-off as such.
My property journey was slightly different than yours. So I probably went the more traditional route. So I was 21, bought my first property in Marlow, £69,000, 2-bed terrace, 1993.
And how much that's worth now?
Yeah, exactly. I think they go for £500,000 now. But so we were there for a year. I bought it because it was cheap and it was run down and it's in Marlow. You're not going to lose.
Yeah.
And did it up. to the best of my DIY capabilities at the time. Did the garden, did the house, etc., and I sold it for 97,000 the year later.
Still a bargain.
Still a bargain. I thought, I'm a millionaire. I know what I'm doing here. So then jumped into my next property straight away for 110. It was on for 100. This was the other thing. Back then you could really negotiate a deal. So I think it was on for 160. I got it for 107. Wow. And there was somebody passed away, and it was in a family, and they wanted to get rid of it. So that was in Bray, Maidenhead. Bought it for 107,000. Did the same again. It was run down. Took a couple more years this time, so it was 2.5 years. Did it up, knocked walls about, etc., and did the whole garden, everything, and sold that for 360,000. So
nice.
Decent chunk of profit, and then carried on from there. Did I make mistakes? Of course. Didn't shop around for the best interest rates. The first property I bought, I was a first-time buyer, and they gave me this amazing rate, which then changed within 6 months. And it's like the mortgage was double. I was like, hello? Things like that, getting the right contractors in, getting the right materials. You don't need to get the highest-end materials. You can get the same look. If you're not keeping the asset yourself, you're just wanting to turn it. I've been involved in loads of different deals where they're flips. Commercial, both resi and commercial, both in the UK and overseas. But the ultimate thing is it's not losing. You're constantly trying to build the initial wealth that you started with. Yeah. So I think my grandparents, it was at the time, gave me the deposit for the first house, which was £15,000. And out of that £15,000, within a 5-year period, I had a pot of money which was in excess of £350,000-400,000. Wow. So when you think of it that way, fantastic investment.
It's interesting when you look back. It's like looking back at. I remember my parents many years ago, and I was wondering how much they bought their first property for. And look at like now, for example, in the area that I live, if you want to go and get a 4 or 5 bedroom house, they're touching £500,000
plus.
There's not a lot of there's opportunities everywhere. I think there was more opportunities many years ago, but it's a different world now because there's different strategies, and there's different. You're dealing with different interest rates, but it's a lot harder to find a deal now than it was many years ago. And I think it's fair to say, look, there's lots of property deals out there, whether that's residential or commercial. And I think the way that the world has changed, it's made some deals less attractive, and it's also made some other opportunities a lot more lucrative. And it all depends what you're looking for as in an investor. And I think that the more modern way of investing now, especially what we've created at Unique with the hands-off method, where it's truly hands-off, where it's guaranteed, it's fixed, it's paid monthly, and it's creating a win-win situation. It's an ethical investment. It's not for everyone. There are people out there that still love to go buy a property, add value and sell it, like the BRR model, where you buy a property, you refurbish it, you refinance it, you rent it back out. That's a fantastic strategy. For example, you would go to find some of the best areas in the country. You'd find the best road in that area. You would then find the worst house on that street. And you would want to buy it for the best deal possible. Then you want to add in value by doing the refurb. And you can get really creative financially as such, where you would remortgage. For example, let's say a property is worth £200,000 and you can get it for £140,000. You go and spend £20,000 to £30,000 on that, and you buy it on a bridge, which is a creative way of borrowing money for a property that's not a mortgage. You then refinance it once you've added value, and you put on a mortgage. You could buy houses for free. There's some deals you have to put some money in, but you can have a small pot of money and get super creative. Those things are out there. One of the things that I like about what we do is we have an investment strategy for multiple different investors, depending on what they're looking for. So if they just want a guaranteed fixed return on their money, if they've got money sat in their bank, look, let's be honest, let's not go into that rabbit hole of banks. But if you've got money sat in the bank, it's not protected, or it might be up to a certain value of £85,000. But what a lot of people don't realise is, what on earth do you think the banks do with your money? You might see on your bank statement, let's say you've got £100,000 sat in your bank. Every time you look at your bank statement or online, it was still there, but they've gone and invested it. Now, I'm not saying they come in to invest it in scheme or investments like us, but those banks will invest it in something. They might go buy a block of flats or X, Y, and Z. They invest your money. That's how banks work. So why would you want your money sat in the bank where, let's be honest, if you're lucky, you're going to get 4 or 5%? that bank is making money off of your money.
Yeah.
When you can put it in schemes like Own the Asset, for example, where you can buy a property that the government leases back off you, you get guaranteed 9-10% fixed yields paid monthly, and you can also sell it back to the larger pension companies or even back to the bank that buys it for 30% more. So you're just getting, well, not only do you own the asset, but you get cash flow.
Yeah, it's a good point on the banks. I mean, the banks are using your money all the time, and whether they make their margin calls or not, they get into trouble, as we all know. The banks are probably making anywhere skywards of 12 to 25% on your money, and they're giving you 4 or 5% as an interest.
From a business, I find it baffling how banks get away with it, and I have a love-hate relationship with banks, especially in the UK. I just think it's mind-boggling how they operate, and if more people understand what they do with people's money, that's not a bad thing. But I just think more people need to be aware, and the more people that you're aware, that will make you think differently. Because there are people out there that are nervous of investing. There are horror stories out there. But there's also people out there, such as ourselves, that operate ethical investments that are completely hands-off, that you would rather have your money in these investments than sat in the bank. And it's hard to convince that to someone that's used to that traditional way of doing things. Yep. But if you look at some of the feedback we get from our investors, I wish I'd done this, they say that all the time.
Yeah. I think for what we do, it can help a multitude of different people. Some people want to break up their asset class. Some people have got a huge buy-to-let portfolio, and the hassle that goes with that, they want to take some of the money out of that and put it in something that's hands-free.
Yeah.
There's other investors that don't have enough money. They want to build a pot of money to actually buy their property. They might be in rented accommodation. They might have just £10,000-13,000. How can they make that grow quickly over the next 3 years so they're in a position to buy the property? And equally, we have a starting level now because we've opened it up to a wider audience. So why isn't it that somebody at £5,000 can't actually invest that and utilise those funds and grow that and sort of nearly double it over a 2 or 3 year period?
Well, if you sorry to interrupt, if you look at the client Angela that came in 2 weeks ago, she brought a financial advisor to our HQ, and he was happy to share this. And if anything, it didn't really downgrade what he had done. But he had put a plan together for her for 10 years. Do you remember? To save this sort of money, to then go out to buy the asset with the money that she's had on. She's come across one of our advisors online, and gone through the process, had a phone call, had a Zoom call with yourself, and had a Zoom call with myself, had to come to a meeting. Then he's then presented us based on our finances and the numbers in the way that the deals are structured. She can get there in 4 years if she does X, Y, and Z. So she's gone ahead. She's more than happy. So it's about understanding there are other options out there than doing the traditional way of buying a property.
And you might not know this, but that financial advisor has now just invested himself.
There you go.
That's
big volumes.
It is, and that is a good point. Because a lot of people say to us, "Oh, are you FCA regulated?" We get it all the time. The FCA, Financial Conduct Authority, yes, it's a regulatory body that looks at investment structures in the UK, typically with banks, financial advisors, etc., which is why they're FCA regulated. The structures and investments that we do in and around property fall outside of FCA regulation, so we're not FCA regulated because we don't need to be. If at any point in the future we need to be FCA regulated, we'll go through that process and become FCA regulated. But currently the structures that we do aren't. So that sort of answers that question for people. But also don't get muddled up in thinking if someone's FCA regulated, you're protected, because you're not. There's a lot of FCA regulated organisations, both financial advisors, investment funds, etc., that go bust, and they do wrong things. They invest incorrectly. They over leverage themselves or they overstretch themselves, and they go out of business. They might have followed all the regulations. Doesn't mean they don't get things wrong.
I mean, a good example of that, if you look what happened to Goldman Sachs, huge organisation that not necessarily went under, but when a large division of it went under, some of the banks that had money in them, they went under as well. And I'm quite sure that they are fully regulated.
So what we do, we as an operation, we operate ethically and with a moral compass and a moral code. We abide by the property redress scheme, the property ombudsman. If there's any regulation that we have to follow or need to follow, we follow it.
We operate within corporate banks.
Yeah, we have corporate banking who are fully aware of exactly what we do and
they get heavily involved in our operations.
Yeah, so it is what it is. We follow the regulations that we have to adhere to.
And also as well, another thing to touch on, what a lot of people don't quite realise in the UK, private investment has been used for various different social housing or assisted living projects for decades. A lot of people don't realise that it's not needed. It's desperately required.
Well, without it, it would collapse.
Correct. And there's lots of people out there that seem to think, well, you're just taking advantage of a situation. I mean, you could argue that's business, but also we're supplying a service, and these whole core products come around us starting by supplying a service, which was properties to these individuals, these organisations. And then it turned around just saying, well, we can create a product off this. It's what we do as entrepreneurs. We've created a product around it that creates a win-win situation. That allows us to offer fixed returns. It allows these government agencies to accept millions and millions of pounds in effectively private funding. They absolutely love it. If you look at as we know recently, we done a site visit and we actually met the people that benefit the accommodation that these people use. And it's fascinating to see the actual work that goes into the benefits these people desperately require.
Yeah. I mean, the invested money that comes through to us into the programs that we run, it helps vulnerable people. It not only helps government funds get utilised, which are sitting there, it helps the providers take those funds, put them into running the operations for whether it's people coming out of hospital, whether it's people with special needs, whether it's people that have disabilities, whether they have learning disabilities or physical disabilities. It gives them a roof over their head with full-time nursing care and staff in place. And we'll be running a whole video log of us in some of the properties and with the actual users of those properties.
That's tomorrow, actually.
And with the owners of the property providers. But there's one in particular. It's in East London. I'm not allowed to say exactly where, but it's in East London. There was one gentleman who's been doing this for 30 years. He's been running a very successful housing provider. He had a few people that were in hospital. They were stuck in hospital, couldn't get out. They had severe learning difficulties and various medical issues. There was a handful of them that were given less than 2 years to live, which is very sad, obviously. But if they stayed in hospital, that would have been it. Basically, they would have passed away. He accepted them into the program he's running in his facility. Those people are still there 10 years on. They're still living. They've got a nice life to the extent that they can have a nice life. But he said without him and what he did for them as his organisation, his company, they wouldn't be here anymore. And that's exactly what we're doing and exactly the people we're helping.
Again, continuing the transparency, and I'm sure that most people understand the social housing assisted living industry has been going for an awful long time, longer than us. Even though that we've just been doing it in the last 12 months, the relationships that we have with these individuals and these organisations, we've worked with them for many years before. One of our business partners has worked with them for the last 21 years. The company's been their same operations that we work within have been going for 19 years. They turn over X, Y and Z. But not only that, a lot of people say, yeah, but there's lots of other companies that do this. There's not a lot of companies that do what we do. We're unique, excuse the pun. But let me just explain this, and this is just to be completely transparent and completely honest with you. There are other companies out there that sell social housing deals. They normally sell, or they are sold on rent-to-rent basis. So what that means is they will then, if there's either a block of flats or a house, an investor is the investor, they become the landlord. So let's say, for example, one company or one group of individuals, they will go and get, let's say it's a block of 100 flats, or let's say 50 flats, they will get 50 investors to become the landlords. They will take on the tenancies with the housing providers, and they're just the landlords. So the individuals working with these housing providers, the housing providers all across the country are so desperate for properties. Obviously, they're going to take all of these properties, but while they're dealing with, on one occasion, they're dealing with 50 landlords, 50 issues, 50 contracts, 50 admins. As much as they desperately need the properties, it's an absolute headache. As you can imagine, let's say one company or one provider needs to increase by 1,000 units. That's 1,000 investors, 1,000 clients, 1,000 landlords they've got to deal with. When they deal with Unique, they deal directly with us. As directors of the business, we become the landlords, and that's what a lot of people don't realise. Behind the scenes, we're the ones that are taking the risk and the responsibilities in our operation. So at the moment, we've got, I think as it stands now in compliance, there's over 700 properties being transferred over. Last month, there were 600. We we become the landlords, we lease it back out to the housing providers. They only deal with one person. So in the next 12 months, we might give them 4,000 units. That's not 4,000 investors. They only deal with us. It's a massive difference. And it's what the providers actually love. So we're now, as you know, dealing with other providers, and they're like, where have you been? And unfortunately, in the industry, we've got one provider that's reached out to us, as you know, and they've turned around and said they're about to give immediate notice to over 600 apartments because they want to only work with one large group. So these people, and we've done some due diligence, and some of these people that they want to give notice to have only signed up in the last 6 months with other providers. So a lot of people think when you go and buy that deal, you're there for 3 years. These people could pull you, they can pull you out of the deal
That's a really good point. Basically,
and this is well known. This is the news, for example.
But it comes down to the contract structure, which where I get involved with that element of the business. All of the arrangements that we have, they're fixed term rent guaranteed for a minimum of 36 months. Some buildings we take for 5 years, 7 years, 10 years. Whereas, Serco reached out to us and said, can you work with us? And I went through their contracts and I said, no way. And they said, why? We'll give you a 3-year contract. We'll give you a da-da-da.
Not worth the paper it's printed,
right?
Said,
you give me a 3-year contract, but you can break it within 2 months. Sorry, it doesn't work. Ours are fixed term contracts. And if anybody is buying into a social housing investment out there, look at the contract. A key point, look at the break clauses. Ours, there's no break clauses. In our case, we're taking the contract anyway directly in our company. But if you're taking an investment out there as a useful snippet, really look at those break clauses. Look at how the housing provider can come out of the building. Look at how they can make pauses in terms of if there's anything wrong with the building, in terms of dilapidations. With ours, we do fully repairing leases, so it's on the housing provider to maintain the building. But a lot of the housing associations don't do that. So just look at those snippets. And then another good question that we were asked the other day: what's your ideal client? What's your ideal investor? And I'll give my pitch, and you chip in. But firstly, we deal with investors aging from 18 through to their late 70s, early 80s. They can range from students that have inherited some money. We've got police officers on board. We've got solicitors. We've got financial advisors. We've got people in capital. We've got high
bankers even.
Yeah, we've got bankers, and we've got accountants. Chartered accountants who are investors in us. So there's no right or wrong. We've got some people that want to leave something for their kids or make something grow for their kids. So they do an investment with us, and it's structured so it's going to pay for their university fees or it's going to pay for the accommodation. We've got some grandparents that want to leave stuff for their children or their grandchildren, so they structure it that way so we can actually do the contract. So the benefit of that contract goes to a different person that actually invested. Then you've got people just trying to invest to buy their first home or get on the housing ladder, whether that's on their own or as a collective with other people. You've got people that are looking to pull away from work. I had a great conversation the other day with somebody who's just selling his business. He's been working like we have and do for a number of years, and he wants to now stop and take a back seat. He's got a young family, he wants to spend time with them, but he still needs an income.
And just to confirm, because I know who you're talking about there, that's an individual that runs a property business in the social housing group, in the social housing industry, for many, many years. He sees the power of our connections and our contracts and wants to stop what he's doing and heavily invest in us and effectively retire.
Yeah. So from my point, it's open to all.
Look, ultimately, someone asked me the other day, who is your ideal client? And look, it's not just anyone who's got money. Ultimately, you need to understand what you're getting involved in. It is completely hands-off. Once you've gone through our compliance and legal stages, it is completely hands-off. If you're looking for an investment where you can potentially get your money back out in 6 months or a year, this isn't for you. The reason being is we don't sit on all these funds. Like someone said the other day, you must be sat on millions. It doesn't work that way. The minute the allocation's done, we get a small fee. Obviously, that's how we have to operate. But 99% of that money goes straight away. It's not something you can claw back, and we need to be honest with everyone that gets involved. This is something where you need to position your capital and leave it for 36 months. Yes, you'll get paid on a monthly basis, but if you think your circumstances might change and you might have to get your capital back in a year's time, this is certainly not for you. But outside of that, it's open to anyone.
Yep.